historically going into a recession like this is bullish for gold. And, the gold doesn't pay interest, so the Fed cutting rates is bullish for gold. Surprise jumbo rate cuts are bullish for gold. And we're going into that at an environment of nominal all-time high prices. So that's extremely bullish for gold. I mean, the gold is making headlines now. It closes not just, a little spike over 2,500. It makes weekly closes over 2,500. We had a monthly close over 2,500. And just 20% higher from here, which would not be a big move in the gold market, takes us close to 3,000. You don't have to imagine, just think about the headlines on the way from 2,500 to 3,000 with gold already making headlines. It's the sort of thing that attracts a lot of attention.
Hey guys, welcome back to Capital Cause, and today we've got fan favorite Lobo Tiggre back on the show. Lobo, thanks for coming back on.
Happy to be with you, Danny.
As always, guys, be sure to hit that like button if you're getting value out of these videos. Subscribe to the channel if you haven't already. And I'd like to make an announcement. I am opening up a Substack this or next week, so be sure on the lookout for that. The link, however, is available right now in the description box below, capitalcosm.substack.com. Bookmark it. We're going to launch it in the coming weeks, so be sure to be on the lookout for that. Lobo, let's just dive right in. What do you see out there in terms of broad strokes for the economy and the markets in general? What's top of mind for you right now?
Well, we're talking right on the cusp of critical data. And, you could say that almost any month, I suppose, or there are a few quiet weeks in the market from time to time. But we've got three significant data points in the U.S. job market coming up this week, culminating with the big jobs report, the non-farm payrolls report on Friday. But this isn't just, I think, an ordinary, okay, here's another month of data. This really is critical at this time. I have long been saying, and your audience has heard me say before, that there is no American exceptionalism. The world is, I think, in a global recession. The US is in recession denial. And that one pillar of supposed strength that's held that up or made that possible has been the US labor market. That strong laborer / consumer, as long as people have jobs, they keep spending.
Mm-hmm.
And the economy looks great. There are people who should know better on mainstream financial media saying that not almost, I don't want to mince words as they do, that by definition, you can't have a recession if the labor market is strong. And actually, that is not the definition. And you can, as dictatorships have demonstrated, you can put, the masses out to work in the rice paddies. Pol Pot did it in Cambodia. That didn't make for economic strength.
You can dig as many holes as you want.
That's exactly right. That's exactly right, brother. You understand. And I think our audience does too. Somehow, all these fat cats on Wall Street with, billion-dollar computers filling buildings full of PhDs, like the Eccles building, that's not in Wall Street, but still, somehow these people don't get it. Or they don't want to get it, perhaps is more likely. But here we are. So what I'm saying is we are at a rubber hits the road point in time. And this is unusual for me. I don't like to make bold predictions and set price targets and things. But we are at that point where, well, one, the long and variable lags typically last around 27 months between the onset of a rate tightening cycle and recession. That 27-month average would have been in July, which, lo and behold, is when cracks started appearing in the labor market. And this is an important point. It's not that cracks are appearing now. They started appearing a month and a half ago or more. So they're widening now. Now, it could be famous last words. Maybe this week we get a blowout jobs report, 500,000 new jobs. Ooh, everything's fine, right?
That gets revised down a month later.
Right. Yeah. But I don't expect that. I think as you and I speak, I don't know when this goes live, but the JOLTS report is tomorrow. I expect weakness in the JOLTS report. Who knows about the weekly claims? That's a more volatile number, but that seems due for a surprise as well. And then the non-farm payrolls. And of course, remember that there's the survey, the establishment survey, which is the official unemployment number they quote in the jobs rate that they like to quote in the media. But it's also in this same BLS report, the household survey. Like if you ask the companies, you have one thing. And if you ask people themselves how things look, you get a different answer. So watch for the household survey results, and there's a lot of different ways we can go. But what I'm saying is we are on the cusp of very important data. I think it's going to show more weakness. I think the trend of these cracks widening will continue. I think to some degree, investors expect that, and bad news is good news on Wall Street. So they think they're ready for this. But if it surprises and comes in weaker than anybody's expecting, I think we could see some really interesting fireworks. I mean, you'll see, ironically, the bad news could still be good news. If the unemployment rate pops up to 4.4, which wouldn't be a big move, but that's almost a full percent above the trough in the labor market, right? I'm probably going on too long. I'm just saying this very important data because this is the pillar. My favorite meme cartoon for the last couple of years has been one my wife drew of this guy with a noose around his neck, and the Fed is holding the rope, and he's balanced on a one-legged stool, and that one-legged stool is the U.S. labor market. I think we're seeing that come to a head now, and it'll be very interesting. And either I'll be right or I'll be wrong, and that will be, this week's data will be key. This coming month or two will really say a lot about whether I'm right or wrong. I think it'll be clear. Either that old wolf was wearing a tinfoil hat and he was a conspiracy theorist or whatever, he was just dead wrong. We'll know that by the end of this year. Meanwhile, I think the data is on my side. I actually feel stronger conviction about my call for this year. Every data print that we've gotten over the last 2 months has reassured me that I'm on the right track and that the recession deniers are wrong. We'll see soon enough.
Yeah, I mean, certainly, like you pointed out, you're not one to catastrophize this stuff. I mean, you're typically one of the more measured people that I have on my show. The fact that you're actually, speaking in terms of, things like this, it's telling in and of itself. But we'll see. I mean, these central planners have a number of tricks that you could never predict what they've got up their sleeves. I mean, we have people from 2008 calling crashes up until, recent day that haven't been accurate. And people have been calling for a recession since 2022. Granted, we may have already had one, or we may already be in one, going off of the classic.
Hence my phrase, recession deniers.
Yeah. Yep. So, be that as it may, how do you play this, Lobo? What is there anything that comes out ahead in this kind of environment? Precious metals, T-bonds, things of that nature, or is it something else?
Well, cash is king in an extreme moment, but this is a key point. I think that I'll be shown right about the hard landing. I think I'll be shown right about that this year. But I think people conflate recession with market crash. Those are not the same thing. And sometimes if things seem fine, suddenly there's a shock and we go into recession, that could precipitate a market crash, but it doesn't have to. And with the Fed having trained investors for years now that bad news is good news, and it's not just training, like the Powell himself has said the time has come for policy to adapt. They're shifting towards focusing on the labor market. Funny thing, greatest economy ever, but the Fed is now going to focus on the labor market, not inflation. I think they're telling us something, right? Pretty clearly. So the market is not wrong to say, oh, gee, well, if the labor numbers come out weaker than expected, that's bullish for rate cuts, which if you're in those risk assets, traditionally you see that. Not traditionally is not the right word, but recent historically, that's bullish for those assets. So you could see signs of recession denier capitulation actually propelling the S&P 500 to new all-time highs. In our crazy through the looking glass economy, central bank distorted economy, that's actually, I don't want to say sensible or reasonable, but that's the reaction function in such a distorted market. So we could see bad news be very good news for risk assets. or not. If it's scary enough where people go, oh, whoa, 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 wait a minute, this isn't what I signed up for, it could go the other way. So that makes me very reluctant to just say, oh yeah, buy Nvidia, buy the S&P 500. This is gonna the money helicopters will take us to new all-time highs. That is a possibility. I don't know what the odds are. What I can say though is that historically going into a recession like this is bullish for gold. And the gold doesn't pay interest, so the Fed cutting rates is bullish for gold. Surprise jumbo rate cuts are bullish for gold, and we're going into that at an environment of nominal all-time high prices. So that's extremely bullish for gold. I mean, the gold is making headlines now. It closes not just a little spike over 2,500. It makes weekly closes over 2,500. We had a monthly close over 2,500, and just 20% higher from here, which would not be a big move in the gold market, takes us close to 3,000. You don't have to imagine, just think about the headlines on the way from 2,500 to 3,000 with gold already making headlines. It's the sort of thing that attracts a lot of attention. And I think I've said this on your show before. I think we're getting to the point where it's demonstrated. We're seeing this in action. The gold stocks have started perking up. There's been this huge underperformance, alligator jaws opening, right, between the gold, the metal itself, and the stocks. And we are seeing the stocks starting to perk up.
Mm-hmm.
The big producers in Q1, they all beat. Granted, the expectations were low, but they all beat. And Q2 is already starting to look good, the results here. So the actual business of gold mining, which so underperformed in the last cycle, is looking much better this time going around. You combine that with the headlines we'll get out of new nominal. It'd take a fair amount to get us to a real all-time high. I think that would be well over 3,000. I haven't done the numbers recently. I think the last time I looked, it was 31 and change, close to 30.
Is that on an inflation adjusted basis or versus M2?
Yes, yes.
Okay.
Well, CPI, for whatever that's worth.
Right.
Right. That's giving the other guy the benefit of the doubt. Using my enemy's statistic makes me less vulnerable to criticism of, oh, you're exaggerating. So if I use the CPI and I adjust the previous all-time high, I haven't done it for a while, but last time I did, it was over 3,100, which is actually not that far from where we are now. That's less than a 30% change. Anyway, the stocks are starting to show some life here. And that's important, because they're still relatively on sale. They're starting to show some life. And we're going into a circumstance where, if I'm right, the headlines are going to bring generalist investors in here. People are going to start looking at what's working, and gold is going to be one of those things that's working. I think that's extremely bullish, and it's an opportunity. That's the answer to your question. So how do we play this? Of course, gold bug likes gold stocks. That's not much of a great headline. But the case I'm laying out here is for, I think, a pretty unique opportunity where, the metal is already up and it's showing great strength. This isn't, a wild speculation of, gee, there's going to be more inflation, more money helicopters, maybe gold will go up. It is up. And the stocks are still on sale, but showing signs of life. So I think that's as close to a no-brainer in the resource sector as you get. Where you want to go from there, I'm not sure, but that's number one. The number two would be avoid industrial minerals. If I'm right, even, the oil patch has been starved for capital. I get it. It makes sense. I am an oil bull. I'm extremely bullish on copper, but nothing like that. No industrial minerals until after I'm sure the recession has done its worst, or that I've been proven wrong. One or the other. There'll be money to be made afterwards, and there's no need to be picking up pennies in front of that steamroller.
What about silver? Silver's a bit of an industrial and a precious metal. So how does that fit in?
Exactly right. So, I get my rotten tomatoes thrown at my Darth Silver mask when I say things in response to this question. Since the second shooting war erupted around the world, the second big one, right, in the Middle East erupted last fall, we have seen silver acting more like a monetary metal. And that's been very encouraging for me as a silver bull. I am bullish on silver. My Darth Silver thesis is not a bear case for silver. It's just that when gold goes back into circulation as not money, currency, I'm not sure that silver does as well. With blockchain solves that, right? We don't need silver to make change for gold anymore. So I'm not sure why, uh, if we not when a new gold standard gets put into place, why it would have to be bimetallic. So that gets me a lot of hate from silver bugs, but that doesn't mean I don't stack silver. I've got more silver stacked than gold by volume, at least. So I'm bullish on silver. I'm happy to see that it's been acting more like a monetary metal should. And for anybody who's missed it, the point there is like, well, duh, silver and gold, they go together, they correlate highly. Of course they do. But last year, silver was correlating more with copper than with gold. Its industrial side is stronger than ever. That doesn't mean it's not a monetary metal, but it does mean that you can't ignore this market dynamic. The industrial side is stronger than ever. That matters. And people get mad at me for saying this, but this is, I think, on the other side of the recession, this is even more bullish for silver. It's the win-win metal, because as a monetary metal, it responds to the turmoil. As an industrial metal, when the money helicopters fly, and it responds to that wildly inflationary scenario that we see following the crisis. But before going into the recession, does it act more industrial? Does it act more monetary? I don't know. Nobody knows that. This is the first time we've been in this situation, and we'll just have to see. It's just, it is worth being cautious, though, because, I mean, look at what happened in 2020. Gold and silver got whacked. Gold comes screaming back, and silver still has yet to hit even a nominal all-time high. So, you can ignore that. You can say, oh, it's just one off, but it is the most recent data that we have. So I just think it's very dangerous to ignore that. And again, I'm not a bear on silver. I'm just saying that going into this recession, if I'm right about recession denier capitulation this year, that could cause silver to underperform. And, big surprise, silver underperforms gold at first and then catches up at the end. I still think we'll see that pattern, but it makes me nervous about speculating more on silver now. If I see a great pick, I'm still willing to do that. There's so few, but I'm the answer to the question is I'm more comfortable betting on gold than silver at this particular moment, though I see more upside in silver when it does one of those whipsaws at the end, as this plays out.
Yeah, there's the old saying, history doesn't repeat, but it certainly does rhyme. That being said, is there any historical precedents in the precious metals market today that you can kind of see parallels to from before?
Yeah, it doesn't repeat rhymes. Sometimes it doesn't. We really are in unique circumstances. I'd like to say, obviously, oh, well, gee, the 1970s, if I'm right about recession and inflation is still high, then that, rhymes with the stagflation of the 70s. And I do think there'll be an element of that out there. It's the closest analog, perhaps. But really, things are different. When we went into the 70s, remember that it wasn't, people say, oh, well, so gold was price controlled. That's the wrong way of looking at it. Gold was still, until 1971, the definition of the dollar. The dollar wasn't just this, good faith and credit of the United States government. It was defined as a certain amount of gold. And private individuals couldn't redeem their paper for money, or real money, not since the 1930s, but international settlement was still redeemable. And that's why Richard Nixon closed the gold window on Charles de Gaulle's fingers. He kept asking for the gold instead of the paper. So, you could call it cold spring. You could call it the unwind of an artificial trade. There's a lot of ways to look at that. But the 1970s bull market was, the basis for it, for precious metals, I hate that expression, monetary metals, is different from now. We don't have that circumstance. And there are other things that are different too. There's similarities, oil shock, there are things like that, war in the Middle East. But we also have the advent of the cryptos. Doug Casey, my mentor, famously used to say that these mining stocks are the most volatile securities on earth. Well, the cryptos have certainly shown that that's not true anymore, right? If you just want to gamble on wild volatility, you think you're going to predict the next big upswing or short the next big downswing, there's more volatility available for you to speculate on in the crypto space. That's just a fact of the market now. So, and this is relevant because if people are attracted to mining stocks, gold stocks, silver stocks because of their volatility, and now there's an asset class that you can, I struggle with the word speculate here, but gamble on that's even more volatile. You don't even have to fly to Vegas to do that, right? You can do it from your phone on Robinhood or whatever. Uh, that's a difference in the marketplace. So I feel like I'm going to get more rotten tomatoes here, Danny. I'm not giving you the rah cheerful, but I'm trying to be accurate. I'm trying to be right.
That's
I
what we
hate
have you
being
on.
wrong. And you know, there are substantial differences between this time and in all historical precedents. Oh, well, gee, I mean, in the federal budget, these multi-trillion dollar deficits and all this stuff, the Fed's balance sheet, they're maybe the historical precedent here is the collapse of Rome.
Mm.
A different world, but it seems to me that the forces that the powers that be are playing with, this house of cards they've built, I don't know when it comes down, but the scope of what we're dealing with is on that scale.
Yeah, and be that as it may, the collapse of Rome was not a soft landing. So,
But it
uh,
also wasn't instantaneous. It was actually a
yeah.
multi-century thing. The sack of Rome by Alaric was just the first of multiple things over centuries. And
Mm-hmm.
now with the electronic age, it's faster, but still, yeah.
Yeah, I mean, yeah, you can kind of see it, with it does seem like the Republic is slowly coming apart at the seams, and whoever wins the presidency, it's pretty much, it doesn't really matter. It does appear like the trajectory is towards more authoritarianism, which is what happened in Rome, right?
Sure. Well, it does matter in a sense, and I don't want to get distracted in politics, but clearly the composition of the Supreme Court, would be
Mm.
different, and the impact of that on the law of the land is significant. But for us as investors, I agree with you, and I've just written about this. Yeah, for us as resource speculators, it's tax and spend versus spend and tax. Both candidates' agendas are highly inflationary. Nobody wants the little guy to suffer. Everybody wants to pander to the voters. That means money helicopters, and it supports everything we've just been talking about.
Yeah. Are you in the market for gold and silver? Then if so, please consider Miles Franklin. They are my gold and silver dealer of choice. So not only do they have super competitive prices that you're going to have a really hard time finding elsewhere, but then they also have top-notch customer support. I know Andy Schechtman, the owner of Miles Franklin, top-notch guy. I wouldn't be recommending them to you if I didn't have faith in their product mode. What you really want to do, however, you want to email them at info@milesfranklin.com, and you want to say that Capital Cosmos sent me in the description line, because when you do that, you can get access to their special pricing sheet. You want to get that special pricing sheet because you're going to get special prices that you won't find on the website itself. So email them at info@milesfranklin.com. Tell them that Capital Cosmos sent you, and you won't be heckled with spam emails, etc. There's no commitment necessary. I promise you that. And with that said, I will let you get back to the video. So, Lobo, you are a contrarian. What's your most contrarian take at the moment that no one else is talking about?
No one else is talking about. Well, gee.
Or insofar as you can
Yeah. No, I
connect
understand
to
the
that.
question. I know that an interviewer hates dead airspace, but let me think about this for a moment. Most contrarian. It's maybe not the least talked about, but I really, really like the oil trade. Not so much coal. I get it. And I know that my other mentor, Rick Rule, likes coal, and a lot of people see that as a great contrarian play. We're going to need more coal regardless. But coal is not so globally fungible as oil. It's a bulk commodity. It tends to be regional market. You need to be more careful with your picks there. And the powers that be are more intent on stopping coal than they are oil. Where even if you brought it to oil and gas is supposedly a transition energy, so they're not even trying to stop it. I just saw a chart today of the increases in capacity in China, and coal is the smallest increase in capacity. So if even China, which desperately needs more power, they're building everything, right? Like Rick says, Solar, yes. Wind, yes. Nuclear, yes. Coal, yes. Yes to everything. That's the answer in China. They need everything. But so even there, the increase in capacity for coal is this tiny little sliver in the chart. So they are clearly trying to do without. And as the other pies or slices of the pie get bigger, then I think that squeezes coal out. So I don't know how long coal holds up. That as a contrarian, it seems like that's the one that's the most hated. Coal is even more hated than uranium. That's the obvious answer for let's go against the herd. But I think that's more dangerous than oil. I think I'm not the only one to say. Actually, Lynn Alden, I think, is perhaps the one I got this idea from, comparing oil to tobacco back in the day.
Right.
When they put the squeeze on the tobacco industry, but people didn't stop smoking. And actually, that drove prices and profits up. I see that in the oil patch. I think we're headed for a world where the just stop oil crowd is ironically going to make a lot of money for investors in the companies that actually have oil. I think triple digit oil is going to be the new normal in the world going forward. If anything, the fact that we're not there now, people think of, $70, $80 oil as high. Well, historically, perhaps that's so. If you adjust it for inflation, not really. I think these prices now are actually a reflection of the global recession. If Dr. Copper tells you something about the global economy, oil does too. And I see the relatively low prices. Heck, we've got a shooting war in the Middle East. Why is gold not triple digits now? Well, I think that's telling you something loud and clear about the global economy. Whatever the central bankers and the government bureaucrats that produce the statistics that investors use.
And oil still at the lower $70 bound?
Exactly. I think this is an extremely powerful tell. We'll see. We'll see if I'm right. Oh, sorry. The answer to the question was, unlike coal, I'm much more comfortable with oil. Oil, can't be stopped, won't be stopped, not for decades. And I think prices are going higher. And okay, permitting is going to get more difficult, and the industry is not welcome. I get that. But for the companies that actually have the goods, right? They're going to be in a good business. It's going to have, Warren Buffett-esque moat characteristics, all that stuff. So, but that's not highly contrarian, but I like it a lot, and I'm just waiting to be sure that the recession has done its worst, or that I've been proven wrong about it. Either way, I see years of money to be made in the oil patch. And I think that's more contrarian than uranium right now. Uranium is actually becoming politically correct. What a world. What a world. But that's where we're at.
As
right
it becomes
now.
more politically correct, you start seeing more downside pressure on it. And we can kind of hone in on that if you want. What's your prognosis on uranium?
So, you could say it's contrarian because it's down and people are unhappy that, it's bulls only like it, or fans of a particular commodity only like it when prices are going up. The fact that the price is at a level that the better mining companies make a ton of cash, like uranium does not have to go up from where it's at now for the miners to make money, at least the miners that have projects worth mining. So there's nothing wrong with uranium the way it is, but nobody's happy unless the price is going up. I understand it. I speculate for capital gains as well. I'd like to see prices going up. But it's important to have this clear in your head, right? There's nothing wrong with uranium the way it is. We are at the incentive level. And by the way, the long-term contract price has more or less equalized with the spot price. So for spot to come back to long-term contract, there's no surprise there. There's another rotten tomatoes. When uranium was going up over $100 at the start of this year, and I was saying, hey, a correction is likely here. Let's not be irrationally exuberant. Boy, did people not want to hear that. But I was right, and all of this is normal, is what I'm saying. That said, if you're worried about high prices curing high prices, and that means it's peaked and it's going down from here, then I will push back on that and say, no, not at all. The low-hanging fruit, right? Your two big producers, you know who they are, bringing their mines back online. That's happening right now. The bigger one is struggling, right? Has slashed its guidance. And the other one, we'll see. They say right now they're bringing their two big mines, 18 million pounds a year, online now, and things look fine. But let's see for the fact. Let's see what once they've done it, how the mines are actually performing. I don't want to hear about their goals. I don't want to hear about their guidance. I want to hear about actual pounds being mined, and we'll see how that goes. And the other ones, the refurbishments or the high margin deposits that can be quickly brought to production, that's also happening right now as you and I speak. There are mines that have been brought back online that are drumming their first yellow cake now. So high prices cure high prices. Well, here we are. Spot is at long term. This is not a disaster. This is fine. And this is with all this new supply coming online. Now we get to see how well these mines do. And then what? If you're looking at some of these high grade Athabasca stories that are going to come on, those are years down the road. Maybe the single most advanced one that's at the project finance stage, they still don't have the money. They still don't have the final permitting in place, right? That's going to be years, let alone the ones where we were earlier on in the stage. So what I'm saying is, if you're worried about high prices curing high prices, that's happening now. And if the worst that we've got is that we've corrected down to about the long-term price, that's not bad. And then we're not going to see new supply for years, whereas the demand keeps going. China was already building scores of reactors, and they just announced 21 more. I think last week that was. India is wanting to do more. The Middle East is wanting to do more. Europe, despite Germany, is doing more. The Japanese restarts are happening. Like the demand outlook, it seems like every week we hear about new demand. And none of these demand models even include the SMRs, let alone the microreactors. So absent a Chernobyl scale event, I think that the demand is going to outstrip the supply for years and years to come. I am extremely bullish, and I see the current malaise as a buying opportunity. Now, why I didn't say this was more contrarian is because I think a lot of people get this. I'm not alone in saying this. And so while people are, grumbling, they're not happy with their uranium stocks correcting now, it's not the kind of hate that we saw in 2022 when people just, people had bought the last spike up and they were underwater and they just hated uranium and people were frothing at the mouth. I got hate every time I posted. I didn't even have to say anything bullish. I would just post that the spot price had risen that day, and I'd post the broker price index, and I'd get hate just because I posted the price. We're not seeing that now. There's grumbling, people aren't so happy, but I think enough people get it that I can't really call this a strong contrarian play. What I can say is that there are quality uranium plays out there that are relatively on sale. So if you missed the big, doubling in uranium last year, I do see this as an opportunity. And in fact, my most recent addition to my portfolio, my most recent buy was a uranium stock.
I see. Where do you see the most asymmetry at? I mean, this might be a little connected with the contrarian question, but asymmetric wise, like
sure.
Yeah.
Well, there we have to go a bit farther out on the limb. Probably not in any of my current favorites, but after the recession, we'll see how things shake out. I know a lot of hard money advocates, a lot of mining guys, hate electric cars. They don't like the subsidies and the government pushed into electric vehicles and so on. And I understand that. I'm an anarchist. I hate government intervention in the market as well. But the fact is that these cars are there and people like them. I mean, Tesla really changed the game here and made electric cars sexy. And younger generations, they want these cars. And so electric cars aren't going away. And where I'm going with this is, yes, there are different battery technologies out there. There's hydrogen potentially farther down that road. But right now, the technology is the current lithium ion batteries. And even the LFPs versus the NCMs, they all have lithium in them. So on the other side of the recession, I could see lithium, which unlike uranium, it hasn't just corrected, it's cratered, right? People are shutting down lithium mines. The big producers are scaling back. They're canceling projects. There's bankruptcy talk in the lithium space. That is the kind of contrarian, hated type sector where I can see the most asymmetry, to answer your question. Um, but it's not something I'm ready to buy yet. If I'm right about the recession deniers capitulating in the months ahead, lithium goes lower. I mean, as low as it's gone, something that's down 90%. If you've gone from $1 to a dime, it could still go from a dime to a penny, right? Another 90% drop
99%,
is
yep.
possible in the worst case scenario. And if you've got, if you've got people just pulling back on buying cars, autos are just one of those things that are very sensitive to recession. You could have stocks on Wall Street hit new all-time highs because of the money helicopters, but on Main Street, people will not buy a new car if they're worried about their income and their savings. And you could see more mines shut down. This could become, a screaming buy at some point. And even if at the end of the day, the lithium batteries go away, we go hydrogen or something else, that's going to take years and years, probably at least a decade. And the recession typically a recession lasts 2 or 3 years. And if I'm right about the money helicopters flying, this one is a maybe another flash recession. So we could see a rebound in lithium, within a year, maybe half a year, depending on how quickly the money helicopters fly. I don't know, and that's not a prediction. I'm just saying this is possible. And you're asking me for asymmetry, so I want to look for something that really is, whacked hard. And nickel's been whacked hard, but that is being replaced. The LFP batteries don't have any nickel in them, but they do have lithium. So I see lithium as a more asymmetrical trade. And I'm not buying it now, but when I am going into it, when I start buying oil and copper, those are no brainers. The next thing I'll be looking at is lithium. And if the market looks right, and if the electric car buying comes back, then I could see buying, it'll be like blood on the streets as far as lithium companies.
What's your biggest concern, Lobo? Like, just in general, in terms of the market or whatever's going on in the world?
Yeah, well, that we'd have to pull back from the market, and I don't want to sound clickbaity or Armageddon-y or whatever, but I mean, we do have two shooting wars, either of which could become World War III. And there's a lot of, I think, smug talk right now about Putin's red lines not being red lines. Ukraine has invaded Russia. They're doing all kinds of things that seem to be red lines before, and Putin hasn't done anything. Oh, it's all his nuclear bluff is just a bluff. But you know what? If he looks at his scenario and he thinks I might lose, or I might get replaced if I lose control of my power apparatus, what has he personally got to lose? I could imagine him going nuclear. And that would be really bad, all kinds of bad.
And if they do replace him, I mean, there's a big line of hardliners ready to take his place.
Yeah, that gets beyond my pay grade. I don't,
Yeah.
I've heard that too, and it could get worse. But yeah, I'm just saying that if that spins out of control, if you back an animal, a wounded animal into a corner, it will turn and fight. So I think that is a non-zero and potentially catastrophic outcome that nobody should ignore. I guess the takeaway from that is, stack more gold and silver. You want your physical in case of the worst. I also think that the other war in the Middle East, that could go bad if Israel decides to act more strength. If Iran makes the wrong noises and Israel decides to preemptively stop Iran from getting a nuke, that could get really bad too. And the China thing, there's a lot out there that's scary. So you ask me, what do I worry about the most? I guess the short answer is geopolitical instability spinning out of control. The powers that be imagine that they are the maestros pulling the levers of the global economic and political system, and they think they're in charge. But it's sort of like somebody who jumps in front of a parade and says, "Follow me." They feel great and powerful as long as they're in front of the parade. But ultimately, the masses can and will, wheel and swoop and go off sideways. And you may not end up with the result that you, the grand designer, thought you'd get. And that's pretty scary to me. So this is actually one reason why I live in Puerto Rico. Most people don't even realize it's part of the United States. I wouldn't want to live near Washington, D.C., or, any place that could be ground zero for an accidental, salvo from some other country. And that's probably enough scary talk right now. But yeah, if you have the wherewithal to, have a vacation home somewhere out of harm's way, I think that's actually a pretty good investment. At the very least, having real money. And, I'm not even necessarily attacking the Bitcoin hodlers or whatever, but if the internet goes down, your crypto's not liquid. So, physical, real money is not a speculation. It's not an investment. It's savings, it's insurance. And I think everybody should have some.
Right. Yeah. I mean, there's all sorts of unpredictability, and it's just a powder keg waiting to happen. Hopefully nothing happens, but the potential is there. There's a lot of potential energy, built
Better
up.
safe than sorry.
Yep.
Absolutely.
Absolutely.
And I don't want it to happen.
Yeah.
I don't want to be in a world where gold goes to 50,000. That will imply so much brown stuff hitting the
Yeah.
fan. It will not be fun.
And at the same time, we also don't want our houses to burn down, but yet we have house insurance. So,
Exactly.
yeah, I mean, I think we've covered a gambit of issues, Lobo. Anything else you want to talk about before we sign off? And also be sure to, drop us your socials and where people can find you.
Sure. Yeah. So I guess I want to say that, you know me, and maybe anybody new thinks, oh, here's another gold bug sounding the alarms and so on, but I'm not like that. Last year, my highest conviction trade was uranium, not gold. I haven't felt this alarmed about the global situation since 2008. And for whatever it's worth, sincerely, this is what I think. It's how I feel. It's how I'm organizing my own finances. And sure, if you want to follow me, it's at Due Diligence Guy on Twitter. And I have a free weekly digest I put out. You can sign up on our website, independentspeculator.com. And you may not agree with everything I say, but the one promise I do make is that we won't spam you with a flood of daily advertisements. I hate that. So check it out.
Yeah, fantastic. Well, if you guys made it to the end of the video, please consider giving us a like. Please consider subscribing to the channel. And I'd like to also remind you to be on the lookout for the Substack launch coming in the next couple of weeks. Link to that is down below. We'll have all sorts of exclusive content for members only, including exclusive interviews, as well as live streams with experts for the members only section as well, amongst plenty of other things. So click the link down below, bookmark it. And with that said, I'll catch you in the next episode. Bye, guys.